Welcome to Oraculum Accounting, Financial Ratios, and Performance Metrics. In this module, we will understand how financial ratios are used to evaluate an organization's financial condition, performance, and efficiency. Financial ratios analyze relationships between key figures in financial statements to convert raw data into meaningful insights. They help managers, investors, and lenders assess profitability, liquidity, risk, and overall financial health. Purpose and importance of financial ratio analysis. Financial ratio analysis helps transform accounting data into useful information about financial performance and position. It allows stakeholders to evaluate profitability, liquidity, efficiency, and risk, supporting decisions related to investment, lending, and management strategy. It also highlights trends and potential weaknesses. Classification of ratios. Financial ratios are grouped into categories for structured analysis. Liquidity ratios measure short-term financial strength. Profitability ratios assess earnings performance. Efficiency ratios evaluate how well resources are used. Solvency ratios examine long-term financial stability. Market ratios focus on investor-related performance. This classification improves interpretation and analysis. Trend analysis and inter-firm comparison. Ratios become more meaningful when analyzed over time or compared with industry benchmarks. Trend analysis shows performance changes, while inter-firm comparison identifies strengths and weaknesses relative to competitors. Liquidity ratios. Liquidity ratios measure the ability to meet short-term obligations using current assets. They indicate whether a business can pay its immediate liabilities without disrupting operations. Current ratio. Formula: current assets divided by current liabilities, shows the ability to cover current liabilities with current assets. A ratio above 1 generally indicates sufficient liquidity. Quick ratio. Formula: current assets, inventory, divided by current liabilities, excludes inventory, and measures the ability to meet obligations using more liquid assets. Cash ratio. Formula: cash and cash equivalents divided by current liabilities, measures the ability to meet obligations using only cash and cash equivalents. Interpretation. Higher liquidity ratios indicate stronger short-term financial security, while extremely high values may suggest inefficient use of resources. Profitability ratios. Profitability ratios measure the ability to generate earnings relative to sales, assets, or equity. They reflect operational efficiency and financial performance. Gross profit margin. Formula: gross profit what sales exempt, indicates profit remaining after covering direct costs. Net profit margin. Formula: net profit true sales cent, shows the proportion of revenue converted into final profit. Return on assets ROA. Formula: net profit 1 total assets no, measures how effectively assets generate profit. Return on equity ROE. Formula: net profit divided by shareholders' equity times 100, indicates the return earned on shareholders' investment. Interpretation. Higher profitability ratios indicate stronger performance, while declining ratios may signal cost pressures or inefficiencies. Efficiency ratios. Activity ratios. Efficiency ratios measure how effectively assets and working capital are used to generate revenue. Inventory turnover ratio. Formula: cost of goods sold divided by average inventory, shows how frequently inventory is sold and replaced. Receivables turnover ratio. Formula: net credit sales divided by average accounts receivable, measures how quickly customers pay their dues. Average collection period. Formula: 365 divided by receivables turnover, indicates the average time required to collect receivables. Total asset turnover ratio. Formula: sales RUD total assets, shows how efficiently assets generate sales. Interpretation. Higher efficiency indicates better resource utilization, while low efficiency may signal operational issues. Solvency ratios. Solvency ratios measure the ability to meet long-term obligations and assess financial stability. Debt-to-equity ratio. Formula: total debt divided by shareholders' equity, shows the balance between debt and equity financing. Debt ratio. Formula: total liabilities divided by total assets, measures the proportion of assets financed by debt. Interest coverage ratio. Formula: earnings before interest and tax divided by interest expense. Indicates the ability to meet interest payments from operating profit. Interpretation: moderate debt can enhance returns, but excessive debt increases financial risk. Market ratios: market ratios evaluate how financial performance translates into investor returns and market value. Earnings per share, EPS. Formula: net profit divided by number of outstanding shares. Shows profit earned per share. Price: earnings, P/E ratio. Formula: market price per share divided by earnings per share. Reflects investor expectations of earnings. Dividend yield. Formula: dividend per share divided by market price per share times 100. Indicates return received as dividends. Dividend payout ratio. Formula: dividend per share divided by earnings per share times 100. Shows the proportion of profits distributed to shareholders. Interpretation: market ratios reflect both financial performance and investor expectations. Interpreting financial ratios integrated example. Liquidity, profitability, efficiency, solvency, and market ratios should be analyzed together to form a complete view of performance. A balanced combination of strong liquidity, profitability, efficient operations, and manageable debt indicates financial stability and sustainable growth, while market ratios reflect investor confidence. Limitations of ratio analysis. Ratios depend on the accuracy of financial data and may be influenced by accounting policies. They can be misleading if used in isolation and may not fully reflect external factors such as market conditions. Proper interpretation requires comparison over time and consideration of qualitative factors. Conclusion: financial ratios and performance metrics are essential tools for analyzing financial statements and evaluating organizational performance. By combining different ratio categories, organizations and stakeholders gain a comprehensive understanding of financial health, operational efficiency, and long-term sustainability. When used carefully, ratio analysis supports informed decision-making and effective financial management. Thank you for watching. Subscribe for more informative content.